Trading in financial markets can be exhilarating, but for beginners, it's often a path filled with pitfalls. Many enter the market with dreams of quick riches, only to see their capital vanish due to a series of preventable mistakes. In this scenario, we'll explore 5 critical errors that can devastate a novice trader's account and discuss how to avoid them. 1. Overtrading, the silent killer, the mistake. Imagine a beginner trader, Jack, who makes a small profit on his first trade. Encouraged, he starts placing trade after trade, chasing every market move. This behavior, known as overtrading, is one of the most common mistakes among novices. Overtrading happens when a trader opens too many positions without a clear strategy, often fueled by greed or the need to make up for previous losses. The result? High transaction costs, increased exposure to market volatility, and inevitable losses. The solution? Stick to a trading plan. Define the number of trades per day or week. Set a risk-to-reward ratio and only take trades that meet the criteria. Avoid emotional trading by taking breaks after a win or loss. 2. Ignoring risk management. The mistake, Sophia, another beginner, risks 50% of her account on a single trade because she believes the setup is a sure thing. Unfortunately, the market moves against her, and she loses half of her capital. This is a classic case of poor risk management. Many beginner traders fail to use stop-loss orders or risk more than they can afford to lose on a single trade. Without proper risk management, even a few losing trades can wipe out an entire account. The solution? Never risk more than 1 to 2% of your total capital on a single trade. Use stop-loss and take-profit levels to protect your account. Diversify your trades across different instruments to reduce exposure. 3. Trading without a plan. The mistake. Emily jumps into trading with no clear strategy. She bases her decisions on gut feelings, random tips from online forums, or social media posts about hot stocks. Without a structured plan, her trades are inconsistent and lack direction. Trading without a plan is like sailing without a map. You're at the mercy of the winds. Beginners often chase trends or enter trades impulsively, leading to significant losses. The solution? Develop a detailed trading plan that includes entry and exit criteria, risk management rules, and performance review processes. Backtest your strategy on historical data to ensure it has a positive expectancy. Avoid making changes to your plan based on short-term results. 4. Failing to control emotions. The mistake. Michael is devastated after a losing streak. Instead of stepping back, he enters a revenge trade, hoping to recover his losses quickly. The trade fails, and his losses compound. Emotions like fear, greed, and overconfidence often dictate the actions of beginner traders. Fear leads to missed opportunities, while greed and overconfidence result in overexposure and poor decisions. The solution? Practice emotional discipline. Accept that losses are part of trading. Take breaks after a loss to reset your mindset. Use tools like trading journals to objectively analyze your performance and identify emotional patterns. 5. Lack of education and unrealistic expectations. The mistake. Sam enters the Forex market expecting to turn $500 into $50,000 in a month, inspired by social media influencers. He uses high leverage, ignores fundamental analysis, and relies solely on luck. Within weeks, his account is empty. Many beginners underestimate the complexity of trading and overestimate their ability to generate consistent profits. They skip the learning phase and dive straight into live trading, often with disastrous results. The solution? Invest in your education. Take courses, read books, and follow reputable traders. Practice on a demo account before trading with real money. Set realistic goals. Aim for steady growth rather than quick profits. The ripple effect of these mistakes, each of these mistakes doesn't just lead to financial loss, it also erodes a trader's confidence and mental resilience. The psychological toll can be devastating, often driving beginners away from trading altogether. However, the good news is that these pitfalls are entirely avoidable with proper preparation, discipline, and a commitment to continuous learning. A story of redemption. Let's consider an example of redemption. David, a beginner who made all the mistakes listed above, lost 70% of his initial capital in just 3 months. Instead of giving up, he decided to approach trading with a fresh perspective. 1. He studied risk management and capped his losses at 1% per trade. 2. He developed a trading plan and backtested it rigorously. 3. He kept a trading journal to track his progress and identify emotional triggers. 4. He joined a trading community to learn from experienced professionals. Within a year, David not only recovered his losses, but also became consistently profitable. His journey highlights the importance of learning from mistakes and adapting to the realities of trading. Conclusion: avoiding the pitfalls, trading is a skill that requires time, effort, and discipline to master. By avoiding these 5 critical mistakes, beginners can protect their capital and build a solid foundation for long-term success. Remember, every professional trader was once a beginner. The difference lies in their willingness to learn, adapt, and persevere. Are you ready to take the next step in your trading journey?